some different options plays, something that you might consider for some idea generation. That means we're going to be talking about options. I want to stress that options definitely carry a high level of risk and they're not suitable for all investors. Before you open an options account, please carefully review the options disclosure document and any different stocks or indices or ETFs that Tony and I talk about today. They're being provided purely for informational purposes only. It's not intended to portray any type of recommendation to buy or sell any particular security or to put on any strategy. It's just so that you get more familiar with what's going on in the markets. All right, so once again, welcome back, Tony. How are you?
I'm doing well. Thank you so much for having me back. Really excited to discuss the markets. We are at a bit of a pivotal point in the markets right now, so would love to talk some ideas with you guys.
All right, so what I'm doing right now is we're taking a look at Street Smart Edge, and let me just pop up, let's take a look at the S&P 500 ETF, which is known as the spiders. Let's pop this up here. And Tony, I do have different simple moving averages. I have the 10-day, which is the orange line. The 20-day is the red line. The blue line is the 50-day. Aqua line is the 200-day. And so, Tony, we had, quite a bit of a sideways market today. But earlier, we actually opened lower. Market sold off on rising coronavirus case counts. And then it seems to have quickly found some support at that blue line that aqua line that we see right here, the 200 simple day. And let me zoom in a bit. So what caused, that bounce back?
I'll be honest, I'm not exactly sure what caused the bounce back, but I will say this is still the base case that we have here in the markets, which is predominantly buy the dips, especially if you actually zoom out a little. Before I look at moving averages, I usually like to look at just the price chart on itself. And we've been looking at the 300, 302 level for months on end. This was a level that we talked about in July of last year. This was a level that we talked about in September of last year. And then it finally broke out in late October, early November. So 300 is a pretty significant level that we've been talking about for quite some time. And it's just hitting that level right now. It bounced off of that last week and is looking to bounce off of that again. Now it happens to correspond with the 200-day moving average, which does provide a little bit more psychological support, if you will. So I think it's a confluence of all of those things. And the fact that the rise in terms of coronavirus cases at the moment has not resulted in a rise in deaths yet. We have seen that the number of deaths flatten out over the past few days. So right now, the question is whether the number of deaths are going to also increase. It sounds like that might happen based on the acceleration that we've seen in terms of number of percentage of positive cases in some of those states, but that's yet to be seen. If we do see a rise in deaths and we see states go back into some form of lockdown, I don't anticipate states telling their citizens to no longer go out or telling businesses to shut down, but certainly more restrictions as far as how businesses can reopen. I think that is the risk that we currently see with the markets. And if we do break below this, what I consider fairly major 300 support level, that's when I think that we would shift more to a bearish view in the markets. But at the moment, we are more neutral, I would say, and cautiously bullish.
Yeah, there was some news that came out earlier today that the FDIC is relaxing some of the Volcker rules. Those are restrictions on banks. And this could actually free up about $40 billion. And so the financials were leading. Let me just show you on the screener. The financials were leading. Yeah, they still are. They're up overall almost 2%. But it's been, a lot of sideways action today. So it's been pretty mixed. Now let's go back. So that's the S&P 500. How about we take a look at what's going on with the Qs? Let's take a look at the Qs right here, the NASDAQ. And, the NASDAQ really has been the leader throughout the year. What's your opinion on where the Qs can go over the next couple of weeks?
Yeah, the Qs by all means, the Nasdaq 100 index is leading the market, and I would argue these days, if you're looking at where the market is going, you should be looking at the Qs, not the S&P 500 anymore. And if you look at this chart, it's a pretty orderly chart, unlike the S&P, where it kind of went a little parabolic and then came back and consolidated for the past couple of weeks. The Qs have had a very steady climb, and every single time it touches that 20-day moving average, it bounces higher off of that. And that's exactly what we continue to see here. So the Qs momentum, certainly, we see a bit of negative divergence here on that last push higher, but it is pulled back a little. The Qs very similar to the S&P 500 in more of a neutral state at the moment. Most of this is because the Qs is heavily, first of all, it's a smaller index. It only has 100 constituents, and it's heavily skewed towards technology and biotech, both sectors that we know have been doing phenomenally well in the current market environment. So that's part of why the Qs have been doing so well. And if we look at both technology and biotech, they are both, from a technical perspective, looking fairly strong. So I'm certainly more bullish on the Qs than I am on the S&P 500.
So you were just talking about technology. So here's the S&P 500 technology sector ETF. These are 70 stocks that are in the S&P 500. Now, if you ever want to see what stocks are in a particular ETF, if you're on Street Smart Edge, what you do is you right click when you're on the chart, and then you simply click on research, and you can see the top 10 holdings right here. If I widen it out, you can see the percentage too. All right. So here's the XLK. So, what are you seeing here? We did, that 20 simple day moving average does seem to be, the same support that we're seeing in the Qs.
Yeah, XLK, very interesting from the perspective. It's just past its February highs right now. It's just February highs, I think, was around 102.88, which is just where it's trading right now. So interesting to see if XLK can continue to close above that level, because right now there certainly, again, is some negative divergence on this last push higher, especially if you zoom out to a weekly chart. The negative divergence, I think, increases the pullback of this sector back into that 94, 95 range here. So these are some of the concerns that we see with the markets continuing to move higher, is that there's this negative divergence that we're currently seeing on these leading sectors, if you will, specifically technology and biotech, that is starting to be a concern. Now, one thing that I will point out is that markets like this can remain overbought, and you can have negative divergence that goes on for weeks, possibly even months, as we saw back in November through February. Markets were overbought during that time. We saw a negative divergence on every single push higher, but markets continue to grind higher. And especially in this market environment where I would say the Fed is predominantly supporting this market right now, our base case is still, you're going to see small dips as a result of this, but those dips are potentially buying opportunities. But again, the risks still skew to the downside, but until they break below some major support levels like the 300 level on the S&P, our base case is still buy the dips.
Now, are you concerned about the upcoming earnings season? It's going to kick off in the middle of July. I mean, FactSet is expecting that earnings, there won't be any earnings growth. In fact, earnings overall in the S&P 500 are expected to drop 43.8%. I mean, are you concerned about, continuing to be bullish as we start getting these earnings reports, or are you looking beyond those numbers, or you think it'll be a little better?
I'm absolutely concerned, but I do think that the markets are fairly forward-looking. But that's part of why the markets have taken a pause over the past couple of weeks, I would say, because that forward-looking guidance has started to weaken, especially as you see this resurgence in some of the states, and you're seeing the developed markets now really accelerating in terms of the cases of COVID and really pushing out where we think global GDP and global growth is going to be in the next year or two. So absolutely a concern, but I'm I welcome the earnings season because it means that we get more data to look at and understand where we want to invest, because we clearly see the post-COVID-19 world as a bifurcated world between haves and have-nots, and potentially also new opportunities as a result of it. So we're really looking forward to earnings season and see where trends exist. You know, we'll talk about some of those trends that we currently see in the markets on this call today, but those are the opportunities that we're looking forward to in July.
Right, and many companies have, you know, pulled back their guidance. So a lot of analysts, you know, they're purely just making just guesses. So it will be great to get the temperature of what's going on with our companies as we go through earnings season. All right, so that's the technology sector. Now you did mention biotech. What's one of the symbols that you like to monitor for biotech?
I use IBB for that just because from an options perspective, it tends to be a little bit more liquid than XBI. So the IBB index is the one that I look at. And if you look at the chart, what's interesting about IBB, especially if you zoom out a little bit further, is that it recently broke out from a double top that it formed going back to July of 2015. So you actually have to zoom out a little further. I don't know if you
Let me
can.
see. Can I go? Let's
There
see.
you go.
You said July. Okay. And what
Yeah.
time frame did you want me to do? Like weeklies? Let's do that.
Weeklies.
Let me do weeklies. There we go.
Yeah, so as you can see, it formed this top back here in July of 2015 around 133.5, and it's been playing around with this level for quite some time, and it's managed to finally break out above it. So I think we have a fairly meaningful break above this 133.5, 135 resistance level that it's been testing for quite some time. It is now broken out above it, came back to retest the 136 as support, and I think now you have a confirmation of a true support level. And perhaps this could be the breakout of a much larger move to the upside here for biotech, especially if you think about all the investments that have been going into the slew of pharmaceutical and biotech companies in the pursuit of COVID-19 cures, COVID-19 vaccines. This is why I'm so bullish on the sector. And then from a technical perspective, I think the timing works out really well. The risk to reward, you have plenty of upside to the upside with what I would consider, I would take on a trade like this with a fairly tight stop, because if IBB revisits that 130, 128 level, I would get out of this trade, cut my losses. But I think there's plenty of upsides on this multi-year breakout.
Now, what about different types of commodity ETFs? So on our watch list, you told me that you like to follow gold, the GLD.
Yeah, so gold has a very similar type breakout, and not going back as far, but gold has been range bound for quite some time. If we zoom into a daily chart between 155, 157, 164 or so. So it's been trading in a very range bound range for quite a few months here, since basically April. And it recently just broke out above that 165 level. So I think, again, also from a risk to reward perspective, I like this particular trade, especially if you're concerned about all the money printing that the Fed is currently doing and what that means for potentially inflation. This is a potential hedge against that. And if you look at the dollar has been getting a little weaker over the past few weeks. That's part of why we've seen gold rally. And from my perspective, the risk reward on this is very attractive. And I would, again, utilize options to try to play for upside. And I would have pretty tight stops here, because if it goes back into that 160 level, I would consider my breakout thesis incorrect, get out of the trade at a relatively small loss while playing for a much bigger move to the upside.
Now, all of these symbols that we have on this watch list here, Tony, you know, how do you decide if you're going to trade an actual ETF over options? Or do you really prefer to trade options, or do you really actually rarely trade the actual ETF itself?
No, I'll trade the ETF many times. So I actually, for example, I actually own GLD as an ETF as well as options on it. Sometimes, especially when I don't expect the move to be a quick and fast move, I like buying. I like buying the ETFs, such as GLD. GLD has been fairly range bound for quite some time, which is why I bought the ETF rather than utilizing options. But now that it's broken out, I'm playing for the breakout utilizing
Mm-hmm.
options. So it really depends on what my thesis on the ETF is and where I think it's going to go. And most of my long-term investments, and I do see gold as a more of a longer-term investment, I would own the ETF itself. Same thing with IBB. I bought IBB prior to the breakout. Now that we've had the breakout, that's when I'm looking to utilize options to play for extended moves to the upside.
So if you have an IRA account, do you maybe trade ETFs a bit more in that particular
Yes.
account?
Yeah, so I would say in my IRA account, for the investments that I have for the long term, they are almost all in ETFs. I'm not a big fan of picking individual stocks for my retirement account. I have a few, but for the most part, I have what we would consider a well-diversified portfolio in terms of asset allocation, utilizing very low cost or low fee ETFs, if you will.
So then you like to trade your options in a trading account, unless maybe you're doing, let's say, covered calls in your IRA or cash secured equity puts. Is that it? It depends on the strategy too.
Yeah, it does. I will say that generally speaking, the low fee ETFs, the options on them aren't particularly liquid. They usually tend to be fairly low price from a dollar perspective, which also makes it sometimes a little difficult to sell cover calls on them. But yes, a combination of using cash secured puts to get into those ETFs and selling cover calls when they are appropriate and when they have enough premium in order to generate off of that. But yes, I do a lot of my options trading in my actual brokerage account.
Now we talked about the S&P 500. We talked about the Qs. What about let's take a look at your watch list. What about the small caps?
Yeah.
Let's
So
take a look.
this Yeah, so a lot of I would say that I've been getting a lot of questions over the past few days, past few weeks, as far as whether or not, number one, are we headed for a correction? Meaning, have we put in a market top and now things are going to turn around? And by the looks of the sell-off that we had a couple of weeks ago, the price action we've had over the last couple of weeks, certainly the momentum in the market has certainly shifted, if you will. And one of the, as the market rallied from those March lows, throughout the entire rally, there were questions as to the health of this rally, as to whether or not this rally can be sustainable. I think a lot of people feel that the S&P reaching that 313, 314 level was a little too far, too fast. And so a lot of the questions that we were trying to answer was, is this market rally healthy? Can this market rally sustain itself? And one of the things that we were looking at to help answer that question was not necessarily the S&P 500, but looking at where is the broader market trading. And if we looked at IWM, which is a small cap ETF, what was interesting about that is that the IWM has been lagging the markets for the past year. It has not been able to make new highs. So in February, it wasn't able to make a new high despite making a high in January along with the market. So this was all telling us that the health of the rally back in January and February was not particularly strong, meaning small caps was lagging behind the broader market. But from March to June, small caps actually led many of the days. So what that led us to believe was that the market rally was substantially healthier and that it could sustain itself. And that's why we kept continuing to buy the dips every single time the market sold off between May through June. Now, and you can look at it in multiple ways, not just small caps. If you also look at the equal weight index, the RSP, which is the S&P 500 equal weight index. Equal weight index, historically from November to February, did not keep up with the overall market. It lagged behind. But from March to June, it was actually leading the markets on many days. So this was, again, telling us that the market rally was sustainable. It was relatively healthy, or certainly much healthier than it was from November to February. But one of the things that we have noticed over the past few trading sessions, and predominantly in the past week, is that the equal weight index and the small cap index have started to lag behind. And this is telling us that the market rally is starting to, the leadership in this rally is starting to narrow. That is a concern for the market rally and the health of the rally. That in itself does not necessarily mean that the markets are headed lower, but does mean that there's a higher probability of a pullback. And if we do get a pullback, they usually tend to be fairly quick and violent when leadership narrows. And that's exactly what we're currently seeing, this trend reverse.
Mm-hmm. And yes, because with the S&P 500, just a few of the big name stocks that had a higher weighting, they've been really, charging forward. So that's,
Yeah.
had that higher performance in those particular names.
Yeah,
All
one
right.
of the concerns that we have right now is the top 6 FANG names. So Facebook, Apple, Amazon, Google, Microsoft, Netflix now account for 24% of the market cap of the S&P 500. So you're talking about 6 names out of 500 that account for almost a quarter of the market cap. When you have that type of extreme concentration in a specific market cap index, that is a concern. Again, that in itself does not mean that markets are going to correct or it's time to go short. It just is something to be aware of as you invest in these types of indices, to know what you're actually investing in. So when you buy SPY, you're predominantly buying a good chunk of these 6 companies.
Right. And you could see Amazon year to date, it's up, over 48%. Netflix, 44% almost. Apple, 23. Or over the past month, you could see the performance for these individual names versus I put up the spiders. And you can see year to date, the spiders it's not bad, only down 5% compared to the depths that we came from. And what I could also put up there is just the RSP to compare. And you could see it over the past month, it has outperformed the equal weighting, the spiders. There we go. All right. And let's go back. All right. So that's the RSPs. Now, what about, let's take a look. I know you wanted to talk about the VIX. The VIX is also on your watch list. Let's take a look at the S&P 500. This is how the options marketplace is currently pricing in the 30-day volatility, and that's being inferred through current options prices. And it's down today, almost 4%, but these are still very elevated levels. We're above 30. So, what do you think about volatility throughout the summer? Will we continue to see these higher levels?
I think you're likely going to continue to see these higher levels, especially going into an election year. I mean, you have quite a bit of geopolitical risk at the moment, with all these countries trying to figure out what to do with COVID and how to deal with each other. You still have quite a bit of geopolitical risk right now in Hong Kong with China, and you have an election year coming up. So for those reasons, I think volatility will remain elevated. So VIX is one way that we measure what the broader volatility of the market is. So with VIX at 32, you're talking about volatility that's almost 3 times as high as it was back in January. And now what that means is that for option sellers, you're going to be able to generate more premium, whether you're selling covered calls, cash secured puts, or even for those of you that are a little bit more advanced and selling credit spreads and iron condors, you're going to be able to collect more premium. So it is a better environment for selling options at the moment, as the implied volatility is relatively high, and the volatility of volatility, which is another thing that we look at, is relatively stable. So VIX not moving a whole lot around, but remaining elevated, really is the right environment for selling premium.
But the marketplace is pricing in that there is that potential for a wider range of movement. And so you're getting paid more to take on that risk. So if we do have those surprise gaps up or down, you want, of course, your strategy, the direction of your strategy to be on the right side, especially if you're running out of time, So,
yeah. So
mhm.
One of the other things that we also look at as far as VIX is where the 30-day VIX, which is the VIX that you're currently looking at, is comparison to the 3-month VIX. So you can actually look at VIX futures, or there's actually a 3-month VIX indicator that you can look at. And you want to take a look at whether the front month VIX is trading above or below the 3-month VIX. That's something that we utilize many times to get a sense for where the market is thinking in terms of risks. So if you look at this, the 3-month VIX going out to September is trading at 33 versus the front month VIX is also at 33. Those two are at the same level. Now, when the front month VIX actually goes above the 3-month VIX, that means short-term fear, if you will, is greater than long-term fear, and that is usually what we consider as a risk-off indicator. So when the front month VIX gets above the 3-month VIX, that is a potential opportunities to think about markets may be heading lower. It might be time to think about putting on a hedge for your portfolio.
So when it comes to options prices, if you just think back to commodity prices, if you do have futures prices that are higher in the future, that means they're upward sloping, that's contango. And then when you have prices that are lower in the longer term, that's backwardation. But right now we've got this, it's an interesting mix actually, because 80% of the time, it's about 80% of the time, VIX futures are in contango, which means the volatility is higher in the future. And what we're seeing is it dips, it's like around 33 right now, then it gets higher in October. What's interesting is that it's not higher in November right now, that it kind of stops in October and then it drops down. So we've got this a mix, you know, it's not back to normal just yet. We've got this mix of backwardation and contango. So it's rather interesting structure right now.
Absolutely. And I think you see that dip in November because that expiration is actually after Election Day. Election Day is on November 3rd. So you have the November one that, the November one that includes the election, which is actually quite interesting that the November one dips.
Yeah, that's the thing. I just, you know what? Here we go. Let me go back. Yeah, that's the interesting thing. It's a very interesting structure that we have going on right now. Whoops, let me go back here. I have to, it logged me out because I logged into it a lot earlier. And then if you're not active on the site for just customer protection, you're kicked out because it assumes that you walked away and you're not very active. But let's take a look at the quote. Let's take a look at a futures chain. We're on Street Smart Central. That's where we could see across different expirations very easily. Let me just pop up the futures. Let me just pop up the VIX futures. Then we have a question. Ron wants to know, how do we interpret the VIX? Is the lack of complacency bullish for the market? So if we have a low VIX, is that bullish for the market? How would you tackle that question?
So great question, first of all. Volatility, we usually think of volatility as a contrarian indicator. What that means is that when volatility is high or when it peaks, those are when markets bottom. And then when volatility is very low, that is, as we say, complacency, that is more of a bearish indicator. Now, the one thing I will say is that we have seen VIX go lower and lower and lower and lower. So just because it's low doesn't necessarily mean markets are going to sell off. But we usually think of VIX as a contrarian indicator, more so for when VIX peaks rather than when VIX bottoms. Because again, we've seen VIX continue to decline for months, many, even times years.
Right. At the beginning of the year, we had very low VIX, and look what happened.
And I do want to point out, and I think this is a great question, because a lot of times we get questions when VIX gets to a new all-time low. Is it time to buy puts? Is it time to hedge my portfolio? And our answer is always no, because VIX, just because it's low doesn't mean that it can't continue to get lower. And we've seen that over and over and over again, because basically every single time the VIX made a new low, if you went out there and bought puts to hedge your portfolio because puts were really cheap, that would have been a losing trade 9 out of 10 times for the past 10 years. And you would have been very lucky in February to buy some puts when they were really cheap. But predominantly, from my perspective, to buy puts to hedge your portfolio, you're better off being a little late, paying a little bit more for those puts when you know you need it, rather than buying in anticipation of a market correction simply because puts are cheap, especially if you use the VIX as a measure of that cheapness of that protection.
But once again, the volatility is still elevated, but of course it's nowhere near those 60 level VIX, 80 level VIX that we experienced a couple months ago. But if the markets, if we move through this year and next year, markets are moving higher and the volatility is, 16, 17, 18, that is for the short term. The marketplace perceives that there's more of an all clear. Doesn't mean it'll stay that way. You could have these things blindside you. Of course, these black swan events have come out. But it would mean that for now, the short term, it's all, more of an all clear. All right, so that's the VIX. Let's go back to our watch list. Now, we had a question from Hitton in Michigan. So do you prefer to buy the gold ETF instead of LEAPs?
Yes, absolutely. I will say GLD LEAPs aren't particularly expensive, but the thing about gold is that there are no fundamentals of gold, from the same way that there are revenues and balance sheets that I can look at for a company, that I can get a sense for fundamentally where I think a stock will be in the future. And that's one of the challenges with gold, is that I have a bullish view on gold, but I don't have a clear sense for in 1 year where I think gold necessarily is going to be. And that's the challenge with buying LEAPs on GLD, is the fact that I don't have a strong target price that I can use some type of fundamental analysis to get to. So whenever we're talking about LEAPs, we usually do it on companies, stocks that we think are going to do relatively well, and usually buy LEAPs on stocks that more from a fundamental picture. You're usually not buying LEAPs, in my opinion, on a technical play, unless it's a really long-term technical play, like the one I've outlined on IBB. So for those reasons, on an ETF like GLD, I prefer owning the ETF rather than a LEAP.
Now let's actually dig in and take a look at some different options plays. Now, which particular underlying would you like to take a look at?
I thought an interesting one in this particular market environment, especially when we're a little bit jittery as far as the markets, and from my perspective, until we break below some of those support levels that are referred to, I'm not ready to pull the trigger on any shorts just yet. So my preference is to be more defensive, so that if we do get some kind of resurgence in cases and states go into more restrictive lockdowns and they slow businesses from reopening, I prefer to take on stocks that will do well in that type of environment rather than shorting stocks, because shorting stocks in this particular market has been very difficult. Fighting the Fed has been very difficult. So my preference is to look at stocks such as Clorox, for example, that recently broke out above its 210 resistance level, came back to retest that level as support yesterday, and is now starting to bounce higher off of that level. So I have a strong fundamental view on this particular stock, especially as we're starting to see a resurgence in COVID-19 cases, and likely hospitals, consumers are going to stock up on these types of products again, and it lines up with the technicals, if you will, from a chart perspective. I think that's a good idea to take a look at here on Clorox.
All right, so can we go over those levels again? I can draw them on the chart. Let me show people how to do that. You open up the tray, and then we can click on support and resistance levels. So what was that support level you were looking at?
It was 210. You got it right on the nose.
Okay. Support at 210.
Yep. So as you can see here, it reached that level back here in May, reached it again in early June, and finally broke out above that level. So it's really almost like a triple top here that you touched back in March, back in May, back in June, finally broke out above it, and now came back to retest that as support and has started to move higher. So that's a confirmation that this what used to be resistance is now support, which from my perspective gives me a very good risk reward trade, because if this stock goes below 210, that would be my reason to cut losses and stop out this trade. That only has about a $5 to $6 move to the downside before that happens. While we've had this pretty big basing formation, you've had this breakout, I think this stock can continue to run quite a bit to the upside. So I'm risking $5 to $6 to the downside on the underlying stock to potentially make substantially more to the upside. So risk to reward perspective, I really like this particular trade, but I usually like to take on these types of trades using options, because this is a stock that has ran substantially over the past few months, and I'm always concerned that you get a pullback, and I want to make sure I limit my losses. So if we type in Clorox, the strategy I think I want to explore here is using a debit spread, the strategy on the right-hand side. So I'll just walk everyone through these strategies. So this is options play. Options play is really designed from the ground up to make your options trading experience a lot easier than having to navigate through the chains on your own. And the challenge with the chains is that for experienced traders, you might have a pretty good understanding as to how to navigate the chains. But I tend to find that for most beginners, trying to figure out what strategy to choose, what expiration to choose, what strike prices to choose, that's not an easy task. And many times when you choose one, you're not exactly sure whether it's the best suited one for you. So what we do here at Options Play is when you type in a symbol like Clorox, and you have two buttons at the bottom of your screen, one says I'm bullish and one says I'm bearish. If you click on I'm bullish, we'll always show you three strategies side by side. So those three strategies that show up on the right-hand side are for bullish views on Clorox, and they progress as a trader. So the first one is always going to be the stock leg. So if you're an equity investor, you're familiar with that. That's a strategy that you understand. And then the next strategy is a simple call option, which is the simplest of option strategies. It's a single leg option strategy that if you're starting out with options, that's what you first learn as a bullish strategy for a stock. And then as you progress, as an options trader. And then on the last strategy, that's a vertical debit spread. That's a more advanced strategy. So as you learn and progress as a trader, you see how debit spreads can potentially offset some of the risk on a long call. And we have whole education sessions just on these strategies alone that you can learn more about. But today what I'll do is I'll just quickly walk you through the three strategies. So to buy 100 shares of the stock, Nina, if you could just click on where it's, actually, if you can scroll up a little. Yep, exit out of that.
Exit
on the,
this?
Yep.
Oh, hold on
Yep.
a second. Okay.
There you go. So as you can see, buying 100 shares of the stock will cost you $21,000. Not everyone necessarily has $21,000 or wants to invest $21,000 or risk $21,000. So the strategy in the middle is a call option, which gives you similar upside to owning the stock, but it only costs you $1,000, which means that your max risk here is only $1,000. Now, the challenge with buying a call option is the fact that because you have to pay for that call option, the stock needs to move up by a certain amount just for you to break even. So in this particular case, Clorox has to reach $222.50 by August 7th, which is the expiration date that we've chosen. So we've chosen August 7th because it's roughly 45 days away. That's usually a good starting point when you're buying options, is to go about 1 to 2 months out. This is just exactly 1.5 months out. But the challenge here is that the stock needs to move about $7.50 to the upside just for you to break even on this particular stock. Now, for a stock like Clorox, $7.50, not a huge move considering it's moved about $5 today, but still you need to factor that into your trading decision. Versus the strategy on the right-hand side, that vertical spread also gives you upside exposure, but it only costs you $835. So now, and you can click on the options play score, the break-even price now is reduced down to $220.85. So the stock needs to move $2 less, if you will, before this strategy is profitable. The stock only has to move about $5, $6 to the upside before this strategy is profitable. So Nina, if you can scroll down to the bottom, there are 5 dots at the bottom of the screen. If we can click on the first one. So one of the powerful tools about options play is that many times when you're using an options chain, and even if you knew exactly which option strategy you wanted to pick, what expiration date and what strike price, many of the challenges that we had as a trader was, if we felt that Clorox was going to go up to 220, or we were concerned that the stock might pull back to 205, it was difficult to do back of the envelope calculations to know how much money would I make, and more importantly, how much money would I lose if the trade went against us. So as an experienced options trader, we would have to do these quick back of the envelope calculations to approximate how much money we would make or lose. But the options play tool does that work for you so that you can actually compare strategies side by side. And I would argue the most important thing for options investors to understand first is actually how much money they're risking. Because if you look at any good any professional trader, they're always concerned about risk first, return second. So what we want to do is we want to say, well, I identified 210 as a major support level on Clorox. But let's say I turn out to be wrong, and let's say Clorox declines back to 200 or 195. So Nina, if you can use the P&L simulator and drag that first column, yep, you can type it in. Let's drag it down to 195. So let's just say, for argument's sake, that I'm wrong on this trade and the stock plummets, right? Maybe cases reverse and they don't actually get much worse. So as you can see, if I had purchased the 100 shares of the stock, I'm looking at about a $1,900 loss on my $21,000 investment. If I bought a call option, I would lose $1,000, so half as much as I would if I bought the stock. And if I bought the call vertical, the strategy on the right, I'm risking $835. So as an options investor, the first and foremost thing that I want to do is make sure I reduce my risk. I limit the amount of risk that I take. So no matter what happens, even if the stock goes to zero, I'm only risking $835, which is roughly, in this particular case, about 4% of the underlying stock price. So I'm risking, or about 4% of the underlying stock price. So even if the stock drops 10% or 20% or 50%, no matter how far it drops, I'm only risking 4%. That is how I'm defining my risk. That's first and foremost. Once I know that I'm comfortable with that risk and I say, okay, I'm willing to risk $835, then I can take a look at, well, what happens if this trade does work out? How much return do I get on my capital? And then what I can do is I can use the price slider and say, well, let's say Clorox goes beyond its 52-week high on a new resurgence of cases. And let's say it reaches 225, let's just, for argument's sake. Now, let's say it reaches 225. So if I bought 100 shares of the stock, I'm looking at about a 4.7% return. If I bought the call option, I'm looking at a 27% return. So the call option gives me a little bit more leverage than the stock. So I'm looking at about a 25% return. But as you can see, the strategy on the right-hand side gives me a 49% return, $415 in profit. So what you notice is that by simply reducing your risk, what you're able to do is you're able to amplify your return. So whenever we talk about trying to get maximum return, the only way to really achieve that is by limiting your risk and limiting the amount of capital that you're actually investing to begin with. That's the only way to increase your potential return. So, and you can use this tool to simulate where you think the stock's going to go, and you can think, well, what happens if Clorox really blows it out of the water and goes up 50 points? You can do all of these different scenario analysis and see what are your potential gains, what are your potential losses, and then see and ask yourself, is this the type of reward that I'm seeking for the risk that I'm taking? And those are the decisions that you need to make yourself, because everyone has a different risk tolerance. Everyone has a different outlook on the underlying market or stock. And you can use this tool to help you navigate that and get an understanding as to how you should trade it. I see a lot of options traders simply follow other investors, whether they sign up for a newsletter or they follow some kind of service, without truly understanding the risks and rewards of the trades that they're placing. So I always advocate, if you get a service or you subscribe to something that tells you what to trade, plug those things into a calculator like this. See what the potential risks and rewards are. Make sure you're aware of that before you place a trade. I find it too often that investors get into a trade without really understanding the risks and rewards, and finding it that as they're going through the trade, as trades are starting to go south or trades are going in their favor, they're not sure when to get out. They're not sure when to take profits, when to cut losses, because they didn't plan for it ahead of time. This tool allows you to plan for that ahead of time, so you know what is my max reward, what's my max risk, so that you can plan ahead and say, at this point I'm planning on taking profits, or at this point I plan on cutting losses.
Now, Options Play, this is a third-party resource. So Schwab does not own Options Play. We're not affiliated with Options Play. But if you want access to Options Play, let me just show you how to get there. If you're on Street Smart Edge, if you go to Launch Tools right here, under the Traders Marketplace, there are third-party offers. You click on this link, and then you look for the Options Play icon on here. And then what you can do is sign up for a free trial through Options Play. All right, so once again, and once you have Options Play, once you have the subscription, it will show up on Street Smart Edge under the Traders Marketplace. And then you could click the icon and actually, just log into the platform. Once again, this is a third-party platform. We're not affiliated with Options Play, but it's a great resource. It's a great resource. So let me go back and just show you Options Play. And the one thing, Tony, is when you're putting on these limited risk strategies, which is great because you could know your risk, that you're putting on from the get-go. I just want to stress that just because you are putting in a smaller debit than if you bought the individual option, don't load up on the number of contracts that you trade. Instead of risking $21,000 on the stock, you're doing a lot less. Don't run out and buy lots of individual options or put on a big spread, because sizing is key. And if you're new to options, new to trading different strategies, start small. Definitely start small.
Yeah, we always, we talk about risk management a lot. And for those of you that do decide to sign up for a free trial, you can look at one of my courses, which is on trading psychology and risk management. One of the things that we always teach, especially if you're starting out, is that you should never risk more than 1% of your entire portfolio, your entire discretionary portfolio, on any single options trade. And there are some mathematical reasons behind that, and I go into those reasons during my webinar. So for those of you that are interested in learning more and looking for education on how to get started, you can get all of that free of charge as part of your free trial with Options Play.
And I know you do a lot of presentations. You actually have one, this afternoon, shortly following mine, at Options Play. And you're also on CNBC. You're a frequent contributor, so that's great. So I know a lot of our attendees, they probably caught you there. But, there's a question that came in, and it's from Al in North Carolina. On Options Play, you can get bullish and bearish ideas. What about neutral? What about if you're, looking for those strategies where you think the stock's going to stay in a range? Do you have something for that?
Absolutely. So we actually have credit spread reports that you can sell, but you can also click on modify for any of the strategies.
Mm-hmm.
And there's a strategy constructor right below that. And you can use that strategy constructor. It was slightly above right there. Yep. And you can select neutral strategies if you'd like.
Oh, great.
And you can select from a selection of strategies. I'll be honest, I don't trade a lot of these strategies. I tend to be very directionally inclined, if you will. But if you want to trade iron condors, butterflies, all of those are available to you at using Options Play as well.
All right. Well, super. Well, once again, Tony, thanks for spending time with us. And just to recap, Options Play, it's a third-party service provider. If you go to Launch Tools on Street Smart Edge, under the Traders Marketplace, click on third-party offers. And when you go through that section, you can look for Options Play and sign up for a free trial subscription. And then once you do that, it can show up on your Street Smart Edge as an icon. Any other closing comments for our attendees?
I just want to say, for those of you that are interested in learning how to trade options, it's something that takes a bit of time, especially if you felt that some of the things that I talked about were a little too quick and you didn't really understand. That's okay. Options trading is really something that takes many times, I find at least a couple of months between the start of that education to the point where you actually feel comfortable enough to trade your first trade. And even that, we're limited to fairly simple strategies like a cover call or a cash secured put. But just understand that, the education that we provide here starts off with giving you a better understanding as to what you'll achieve if you do go through that education, so that you can decide for yourself whether or not you want to invest that time to learn about trading options. It can be very fruitful, but it also is sometimes there are a lot of complexities to trading options. So it's important that you go through that education, that you don't just jump into it head first.
All right, well, great. Thanks again, Tony, for spending part of your afternoon with us. I just hope that you stay safe. Take care.
Thank you so much. You too.
All right, well, that was Tony Zhang, Chief Strategist of Options Play, and we've got a lot of sessions coming up next. We have Start Trading on Street Smart Central with Kevin Green and Joseph Schulte. So everyone, stay tuned. Take care. Bye-bye.